Hello, America. I'm Jed Morey with an important public service message. In these troubled times, people all across our nation are asking themselves the same question. Why the f*** are gas prices so goddamn high?
Gasoline prices really doubled.
Well, there seems to be no shortage of explanations as to why this is happening. They range from trouble with Iran and growth in China to the stalled Keystone Pipeline and President Obama's energy policy. None of these, however, has anything to do with the price of oil. The story of high gasoline prices is best illustrated by describing the flow of oil and money through the intersection of Wall Street and K Street, and ultimately into the hands of a few mega corporations. But of all of the corporations involved in the complex pricing scheme behind oil, there's perhaps no company more influential than Morgan Stanley. Welcome to the Gospel According to Wall Street and the Book of Morgan. In 1999, Congress tore down the wall between commercial banks and investment banks and created Frankenbanks with unlimited access to capital. Over the next few years, three things happened that would change the face of commodities investing forever. The first was the formation of a new electronic trading exchange called the Intercontinental Exchange, known as the ICE. The second was a bill authored by then-Senator Phil Gramm that was signed by President Clinton in December of 2000. The bill, known as the Enron loophole, gave energy companies the ability to trade energy futures without federal oversight. We all know how that ended: rolling blackouts, energy price spikes, and the eventual collapse of Enron. Yet despite all of these calamitous events, nothing changed in the way energy was traded. In fact, things only got worse. The final piece of the puzzle came in 2006, when the Bush administration granted the ICE status as a foreign exchange, thereby exempting it from all U.S. regulations and eliminating transparency in trading. The net result? The ICE is now a billion-dollar exchange, handling one-half of the world's oil trading. When the ICE was formed in 2000, the commodities market was a small, highly specialized field with less than $10 billion in assets. Today, it's almost $450 billion. These were the moves that set the stage for one of the greatest scams of all time. And seated at the head of the table is Morgan Stanley. Morgan Stanley is one of the world's premier oil trading companies, which is why investors around the globe look to them to forecast the future pricing of oil. They're like the odds makers in Vegas, only this game is totally rigged. And to understand the con, all you have to do is follow the money. And in this case, the crude. Oil is pulled from the ground or the ocean and refined for our use. Then it's transported on vessels such as this one, owned by a company called Heidmar. Eventually, it finds its way to terminals, giant storage facilities like this one, owned by TransMontaigne. At this point, the oil is sold to more familiar companies like ExxonMobil and Chevron to be purchased by the consumer. Pretty simple. So simple that prior to 1999, volatility in oil pricing only occurred when there were major supply and demand issues, which were always based on real-world events like embargoes, industrial growth, or even revolutions. But none of these factors is present today. We're still in a global recession, demand is down, and we have a surplus of oil. And despite all of the provocations and saber-rattling with respect to Iran, oil is free-flowing around the globe. Now let's go back for a second and take a closer look at the supply chain of oil. Remember Heidmar, the oil freight company? Heidmar owns 120 massive oil tankers. It so happens that Heidmar is a wholly owned subsidiary of Morgan Stanley. And TransMontaigne, the terminal company that owns 1/3 of the oil terminals in the United States, also owned by Morgan Stanley. And if you happen to live in the Northeast, don't worry about ever running out of home heating oil, because Morgan Stanley owns the majority of the federally mandated reserve. But wait, there's more. Morgan Stanley also owns $900 million in Chevron shares and $1.2 billion in ExxonMobil. And that's just the oil. Now, let's follow the money. The 25-page single-spaced document attached to Morgan Stanley's year-end financial statements discloses every one of Morgan's subsidiary companies, including 207 corporations registered to the Cayman Islands. Since no one can actually see what goes on at these companies, there would be no way of tracking what exactly they're investing in. This means that the outside investors who rely on the advice of analysts at Morgan Stanley are likely competing with Morgan's own companies who have direct access to the analysts. In theory, Morgan Stanley could actually recommend buying or selling one way while investing another way, leaving outside investors holding the bag. Now, I know what you're thinking. A bank as reputable as Morgan Stanley would never bet against something they told their investors to buy, right? Right. Mortgage-backed securities. But wait, it gets even better. Thanks to the Enron loophole and George Bush's foreign status gift to the ICE, we can't really see anything that's happening on the exchange. The ICE has even been accused of allowing something called a round-trip trade, where a company takes the exact same position on either side of the trade, thereby eliminating risk and profit while increasing volume on the exchange. Seems strange considering an exchange makes money on fees, so the only winner in this scenario is the exchange. Which brings us to the coup de grace. Guess who's one of the founding members of the ICE? You got it. Morgan Stanley. Morgan, along with Goldman Sachs and BP, started and is still an owner of the ICE. Remember that the commodities market has grown from 10 to 450 billion in assets in little more than a decade. Pretty incredible growth, until you consider that the equity market is 36 trillion, the debt market is 82 trillion, and the derivatives market, a whopping $790 trillion. So what's the big deal, right? The big deal is that Morgan Stanley and any company sophisticated enough to hide billions of trading dollars from U.S. regulators can move the entire market without ever having to touch a drop of oil. To make matters worse, the Federal Reserve has been pumping dollars into the economy so money is cheap and buys less, making oil and gas even more expensive to the consumer. All of this is, of course, deeply troubling, and while $4 and $5 at the pump will hurt the overall economy, there are far greater consequences. Sustained periods of high oil pricing have a direct impact on food pricing. So much so that both the World Bank and the IMF have stated that speculation and manipulation in the commodities market are quite literally causing hunger and starvation. Shipping, storing, pumping, investing, and trading. Morgan Stanley is involved in every stage of the oil production and money-sucking process. It has more influence over the price of oil than any other corporation in the world. So the next time someone tries to explain to you why oil prices are so high, give them a little religion and convert them to the Book of Morgan.